What we're going to do is to start at a very high level and talk about macroeconomic trends, mostly thinking of the economic variables that matter most for your bottom line. So I'm going to introduce my colleague, Christian Rangasamy. Christian is a principal economist at FCC. Christian, how are you?
Hi, good afternoon, JP. Good afternoon, everybody.
So Christian, last year we did the exact same thing. We kind of started out the 2025 outlook at the time about a year ago, and kind of just thinking of the same questions. And I recall the forecast for interest rates because at the end of the day, when we're traveling across the country, interest rates is kind of the most popular topic, I would say, that people are talking about. So. And I remember that our forecast, I'm going to give ourselves an A, or give to you an A in terms of the ability to forecast interest rates, because our forecast for the end of 2025 was the Bank of Canada rate at 2.5%. Now it stands at 2.25%. So if you think of the economic environment overall and the possible connections to the Bank of Canada rate, what do you see in 2026?
Yes, you're right. So last year we had forecast of interest rates for Canada that were lower than consensus expectations. And as you mentioned, those forecasts were not too far off from what actually happened. For 2026, we're again lower than consensus on our forecast for interest rate and also GDP growth. I'll explain that in a minute why that is the case. We're concerned about Canada's growth prospects largely because of America's trade war, right? So we know the Canada-US-Mexico agreement, or CUSMA, will be reviewed later this year, and it's unclear if it even will be renewed. So tariffs are not going away anytime soon. That's the bottom line. And if 2025 is any guide, look for that to exert a heavy toll on our tariff hit exporters, right? Like things like steel, aluminum, and so on. But let me show you a chart here that shows the damage, right? So, and when you're looking at this chart, remember that the majority of our exports to the US is tariff-free, thanks to CUSMA. And yet, outside of the energy sector, our exporters have really struggled, right, since the US tariffs were imposed. When you look at the third quarter of 2025 compared to before tariffs were implemented in the first quarter, basically most export categories are down, right, including tariff-free categories like farm fishing and intermediate food products and consumer goods. So perhaps that has to do with some exporters finding out that they do not meet rules of origin requirements and are therefore not CUSMA compliant. Another explanation is the fact that the US is increasingly getting its imports from elsewhere, right? So that's why I wanted to show you a second chart, which basically shows you that our share of the US market has been declining, right? So 30 years ago, that's the next chart. Yeah. So 30 years ago, you could see that Canada's share of US goods import was around 20%, right? Last year, our share of US market was roughly 11%. So that's the lowest ever. So you have basically a decline of 9 percentage points over 30 years. And the largest beneficiary of that was Mexico, right? So Mexico saw its market share in the US grow by 6 percentage points over that 30-year period, right? So right now, the last time I checked, it was 15%. We're at 11. So what I'm trying to say here, to highlight here, is that it's never a good sign when your biggest customer is finding alternative suppliers, right? So last year, more than 70% of our goods exports went to the US. That's why it's super important that Canada diversifies its client base. And we've seen this, especially this year. But but signing trade deals is fine, right? But it's not as easy as it sounds, right? So we have trade agreements, free trade agreements with 51 countries, and yet we have not been able to materially reduce our dependence on the US, right? Part of a reason for this is the fact that we're not capitalizing on opportunities presented by those trade deals. And I can give you an example here. Canada signed an agreement in 2017 with the European Union, right? I think it was Comprehensive Economic and Trade Agreement, a very impressive name. It was certainly impressive for the European Union because over that last 8 years, they've exported, right? The exports grew by 40% to Canada. Our exports to the European Union have barely budged over that 8-year period, right? So we're struggling to even take advantage of the trade deals we've got already. So why would anybody think new trade deals will immediately boost our exports, right? So bottom line here is that it's not looking great on the trade front, at least over the near term. So that's on trade. the domestic economy is also an area of concern for us, right? So part of this is because of a trade war, which has effectively caused business investment to dry up. So we know that based on the data we have. And the thing is, we don't see much of a rebound in 2026 in light of business confidence still being really low and ongoing uncertainties with regards to the extension of Kuzma. And also part of a weakness, and that's super important for the domestic economy. So not just investment, it's also the consumer, right? So that's 60% of GDP. So we know there's weak population growth, record high debt, and a challenging labor market, right? So we know the jobless rate climbed to 6.8% in December. And so all of that should weigh on consumer spending this year, right? Burden of debt service, which already absorbs more than 14% of household disposable income. Well, that's unlikely to improve much, considering that a large share of households that are renewing mortgages in 2026 will be doing so at higher rates than at origination, which is 5 years ago when they originated the mortgage. And this chart that you can see on the screen right now, this comes from the Bank of Canada, and it tells a story, right? So as you can tell, on average, mortgage payments will increase by about 6% this year. But for those people, those households that are renewing their fixed year 5-year mortgage, which by the way is the most popular mortgage product in the country, well, for those folks, payments will increase by about 20%. That's quite a shock, right, for those households. And that's why I think consumption growth could soften a bit this year. And again, that's about 60% of GDP, right, which is about to slow down. So it's not all negative though. So there's one positive for the Canadian economy is that the federal government is stepping up to the plate with ambitious public projects, and we've seen the announcements, right? And those announcements have potential to rekindle business investment, private business investment. But one thing to bear in mind is that those large-scale capital investment, they're not as straightforward as it sounds, right? Because if history is any guide, disbursements can take a bit longer than originally planned. So don't get me wrong. We expect like those projects to boost the economy, like investment in Canada, but it's probably not a 2026 story, right? It's probably something more like next year or even 2028. So all in all, if you consider those twin challenges, basically from trade and on the domestic front, we think Canada's real GDP growth will slow significantly to around 1.2% in 2026. So that's about half a percentage point lower than what we estimate it was last year. So what is 1.2% growth? Well, that's well below the economy's estimated potential GDP growth. So meaning that the output gap or excess supply in the economy is probably going to widen, right? So another way of saying this is that basically inflation is going to moderate in 2026, right? So JP, we think the overnight rate has room to fall further in 2026. I understand that what we're saying here is quite different from consensus on interest rates because most forecasters are predicting either no change to the overnight rate or even an increase later this year. That may well be the right forecast, right? If the economy picks up materially. But for reasons I mentioned already, we think economic growth will weaken this year. And if we're correct about that, additional stimulus by the central bank should not be ruled out.
So if I'm trying to summarize, so Kuzma, and then Kuzma, the U.S. trade or the trade agreement with the U.S. and Mexico will have the chance to get back to it a number of times throughout the presentation because it does have an impact or potential impact across a lot of different sectors. But with some of the headwinds on trade, and it's a positive to see the warmer relationship with China, and we'll again get back to that a little bit later. But some of the headwinds on trade, I really love the chart. We don't need to bring it back up on the screen, but I really love the chart about mortgage renewals because those 5-year mortgages 5 years ago were actually originated at the lowest fixed rate environment that we had seen in a long time. So that even if rates are relatively low, historically speaking, then that means that they're still going to have to renew at a higher rate. Talking about households, talking about businesses. So it does have an impact. And we're saying, if I heard you right, Christian, we're saying maybe potentially no rate movement in the first half of 2026, but maybe in the second half of 2026, if there is a movement, we think that it's more likely to be down than up, just because of some of the headwinds that we could anticipate for the Canadian economy. Let's talk a little bit more about fixed rates, because then really briefly, like I always like to draw the comparison between, the Bank of Canada rate, which is one thing, but then all the other interest rates are set by financial markets. And so what is the likely trend? So maybe a variable, we are where we are. We had a bit of a decline, steady, maybe a further decline, slight decline towards the end of 2026. When it comes to fixed rates, what can we say, Christian? Are we expecting the same pattern, or is that going to be something different?
I'll say different, right? So folks using variable rate products will benefit from lower Bank of Canada rates, if we're right. But borrowers who go for fixed rate products, in our view, may not get much of a reprieve, right? Because those products are tied to the 5-year Government of Canada bonds, whose yields are, in our view, unlikely to fall a lot over the next year. And that's because those long yields are highly correlated to the US bond market, right? So given the deteriorating US public, US fiscal position is really deteriorating. You have persistent inflation in the US, in part because of tariffs, and also the unpredictability of US policy, right? So we got an example this week, right? So because of all those things, investors are demanding a higher yield, right, to hold US government bonds. And that's unfortunately also pushing up Canadian long-term yields.
Yeah, so don't expect fixed rates to fall is what I'm hearing. So maybe just to close out the section on the macroeconomics, and we do provide a quarterly update, very specific forecasts based off those macroeconomic variables that do matter. One of those variables that I believe matter is the value of the Canadian dollar. It has a number of different influences throughout the agri-food supply chain, depending on the export position, import position. But what can we say about the likely pattern of the loonie in 2026?
Yeah, always tricky, right, to make currency forecasts, but it's given the complex dynamics at play here, in the foreign exchange market. But I'll give it a shot, right? So last year wasn't a good year for the US dollar, right? So that was a great opportunity for other currencies like the Canadian dollar to appreciate against the US dollar. The Canadian dollar did appreciate against the US dollar last year, but not as much as other major currencies, right? So, and part of a reason for the relative underperformance was the soft Canadian economy, right? And also our deteriorating trade deficit. So, but a major drag on the loonie, I think, was the yield disadvantage versus the US, because as you know, the Bank of Canada rate is much lower than the US Federal Reserve's policy rate. And I have a chart here that tells the story, right? So you can see on the screen, Canada's yield disadvantage is quite significant. And if, as we expect, that yield disadvantage doesn't change a whole lot this year, that would continue to favor capital flows towards the US instead of Canada. So all in all, I think fundamentals for the loonie aren't great. So I would say, considering the projected path for interest rates in both the US and Canada, a trending range of, I'll say, 72 to 74 US cents for the loonie seem reasonable to us for most of 2026.
Okay, maybe a little bit of upside from where we are, thinking about where we could end the year, but not that much of a movement. Okay, thanks, Christian.